Hello all. Good evening and welcome. I am Ridul Mishra from the corporate communication team, and on behalf of CareEdge, I welcome you to our today's discussion on securitization, performance trends for retail asset classes. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Gauri Shankar Agarwal, CFO, Shriram Housing Finance Limited, Ms. Aparna Mantha, Senior VP and Head Financial Sector Credit at HDFC Bank Limited, Mr. Nihas Basheer, partner at Wadia, Ghandy and Company, and Mr. Ramadasu Bandaru, Vice President, Yubi from Pools. This session will be moderated by Mr. Vineet Jain, who is a Senior Director at CareEdge. We will commence this session with a presentation by Sriram Rajagopalan, who is the Associate Director at CareEdge. This will be followed by a panel discussion and Q&A session. In case of any queries, participants are requested to key in your panel. We can take up your queries during a panel discussion session. Now, may I invite Shriram to make his presentation, please?
Good afternoon, everyone. We extend a warm welcome to our esteemed guest speakers and all the attendees to this webinar on performance trends for retail assets. We have compiled a short presentation and will follow this up with a panel discussion. Please note that these views of the panelists are their individual views and may not necessarily represent the views of their institutions. We request the participants to submit their questions in the question box on your screen. We will start with a short synopsis for today's event. The securitization market seems to have swiftly adapted the new guidelines introduced in September 2021. And in that sense, the new guidelines have not really been very disruptive. The securitization regulations were first introduced in India in 2006, which was subsequently revised in 2012 and 2021 by the Reserve Bank of India. These regulations have ensured orderly development of the securitization market, with peak volumes reaching to 2 lakh crores just before the pandemic. And in our view, the regulatory enablement of PSL certificates has been a game changer in the PSL market. And this has had a negative impact on the PTC market. Though in its early days, the regulatory thrust on co-lending could be a key disruptor for the market going forward. The direct assignment market is also facing operational evolution in terms of loan level booking and application of prudential norms. Barring a few SFBs, the primary sellers in the market have largely been NBFCs. Any reference made towards NBFCs includes housing finance companies, which are a large constituent of this market. On the investors' side, the market is dominated by banks, with participation from a few large and mid-sized NBFCs as well. Mutual funds, which were earlier active in the PTC market, have been missing from action, and the participation from insurance companies has also always been muted, apart from some participation from India's largest life insurer. There have been no traction from provident funds or pension funds in the PTC market. In terms of the investor product preference, there are clear trends which are emerging. For example, MNC banks prefer PTCs, whilst PSU banks generally have a preference for direct assignment transactions. Last few years have witnessed many challenges emerging from demonetization, GST implementation, the COVID-19 pandemic, etc. However, despite these disruptions, the credit ratings of PTCs have remained fairly stable. PTCs have the potential to emerge as an instrument of choice in stressed economic scenarios, given their stellar rating stability. Retail asset pools have exhibited resilient performance through the economic cycles, and the bounce back in collections has been impressive, with some lag after pandemic-induced lockdowns. With this backdrop, we will briefly touch upon the market volumes. We will first look at the overall market volume trends. Q1 FY23 volumes have more than doubled from Q1 FY22, continuing the positive momentum seen in FY22, given when the market witnessed a growth of 26% compared to FY21. With volumes posted in Q1 recouping some of the lost ground as a consequence of the pandemic, the signs are encouraging for full year FY23. In the current fiscal, we expect the market to grow by around 40% as compared to FY22. Direct assignments continue to command a lion's share of the overall volumes, and the DA-PTC split has largely been 60 to 40 in favor of direct assignments over the past few years. It is interesting to note that the PSL certificate volumes have been in excess of around 6.6 lakh crores in FY22, and this represents a growth of around 12% as compared to FY21. Moving on to the next slide, within DAs, the dominant asset class continues to be mortgage-backed securitization, referred to as MBS, which include both home loans as well as loans against property. The aggregate size of MBS pools was around 13,000 crore rupees in Q1 FY23, followed by asset-backed securitization. ABS transactions include pools backed by all other asset classes other than mortgage-backed securitization and microfinance loan pools. MFI loans made up around 13% of the DA volume. The PTC volume was mainly driven by ABS pools, contributing around 73% of the total issuances in Q1 FY23. The leading asset class driving PTC issuances was vehicle loans at around 7,600 crore rupees in Q1 FY23, accounting for around 59% of the total ABS volumes. With this brief update on the market volumes, we now move on to the performance of retail assets. We will briefly cover rating resilience of rated exposures and the performance trends of a few asset classes. In this slide, we are presenting data related to rated PTCs, including old rated direct assignment deals. This covers all senior tranches rated by CARE since 2010 onwards, covering over a decade, which is sufficient to see multiple cycles of different asset classes, including a minimum of two to three cycles of home loans, which have the longest tenure. Apart from the natural calamities which have occurred during the 12-year period, this period also covers the immediate aftermath of the global financial crisis, demonetization, NBFC liquidity crisis, GST rollout, and last but not the least, the pandemic-induced national and regional lockdowns and supply disruptions. In this sense, this period can be taken as covering economic cycles as well as extreme situations. As can be seen in the presentation, the credit rating assigned to the senior tranches in 96% of the total rated transactions have never been downgraded. Of the balance, the credit rating has been upgraded back to the initial rating for 2% of the transactions. These transactions were performing well, and the downgrades were largely attributable to legal challenges or process rather than performance. Most of these transactions have also seen a change in the servicer. The ratings in around 0.6% of the transactions have been withdrawn after the principal and the interest have been fully repaid. The balance 0.9% transactions continue to be rated below their initial rating. However, all of them are currently rated in the investment grade. This largely reflects resilience of PTCs in terms of rating stability, the point that we have made earlier. Additionally, while there can be mark-to-market or provisioning costs, there have been no credit losses on the senior PTCs rated by CARE. Now we finally move on to the performance trends on a weighted average basis for the respective asset classes. The analysis takes into consideration the universe of care-rated PTCs only. We will be covering performance of pools backed by microfinance loans, vehicle loans, LAP, and home loans. We have shown the weighted average collection efficiency trends as well as the overdue and 90 plus DPD trends for each asset class. While in the case of MFIs, we have shown the 30 plus DPD trend. The collection efficiency graphs represent the total collections, including overdue collections, against the billings for the respective months. Collections are exclusive of prepayments. So the first asset class we will be covering are microfinance transactions. The microfinance pools were the hardest hit due to the pandemic, with the collection efficiencies dropping below 80% in the non-moratorium months. After the lifting of the moratorium, delinquencies shot up significantly with 30% DPD touching almost 12% in December 2020. As can be seen on the graph on the right of the screen, the overall performance gradually improved with some bumps along the way due to the resurgence of the pandemic. Vehicle pools, which are mainly composed of commercial vehicles, witnessed a drastic fall in collections due to the pandemic. The second wave had a significant impact, with collection efficiency dropping well below 85% before recovering. The chip shortage issues also proved to be a hurdle for new originations. As can be seen in the graph on the right, the past few quarters have witnessed an uptick in the performance with a gradual improvement in delinquencies, with 90 plus DPD also falling below the 5% level. Home loans have performed the best across all the asset classes. They have exhibited the lowest volatility in collection efficiency, having never fallen below 95% during the non-moratorium months. Delinquencies have remained well below 1% throughout and have been coupled with very marginal overdues. So this reinforces the perception that the home loans are the most consistent asset class. LAP pools have witnessed higher volatility in performance as compared to the housing loan pools, with collection efficiencies dipping below 85% during the second wave of the pandemic. However, they have also shown improvement in delinquency levels since Q3 FY22. Now we move on to the broad outlook for the securitization market. In India, we seem to have managed the COVID-19 pandemic very well. While it may never be eradicated, it is unlikely to have a significant impact moving forward. The securitization market is expected to grow by around 40% in FY23 over the previous year. There are challenges on the global front, especially fears of a global recession with rising inflation and rates, supply disruptions, etc. The domestic macros are obviously impacted by the global scenario, but we do not expect them to significantly deteriorate any further. The downside of the increasing interest rates could be postponement of the home purchases by the buyers. It is likely to impact credit growth in general and affect other asset classes as well. A push for co-lending coupled with continued PSL classification for on-lending will be an important factor affecting the securitization volumes moving ahead. However, given the exemplary performance of securitization transactions till date, the resilience of rated retail asset PTCs is expected to continue. And on this positive note, I would like to hand over the reins back to Mridul. Thank you.
Thank you, Shriram. Dear attendees, as requested, you can key in your questions in the panel provided, which will be taking up in the upcoming panel discussion. Now, may I invite Mr. Vineet Jain to take over the session, please? Vineet is a senior director at Care Ratings. He is a chartered accountant and company secretary and has 25 years of experience spread across credit ratings, structured finance, debt, capital markets, and corporate banking. He was a part of the founding team of IDFC Bank and was instrumental in setting NBFC lending back as part of FIG, that is Financial Institution Group. Over to you, sir.
Thanks, Rudel. Thanks for the nice introduction, and good evening to all the panelists and participants. We have 4 panelists today for the webinar, and I would like to thank each one of them for agreeing to be part of this panel discussion. Just to reiterate to the participants, the views of the panelists are personal views, and the institute they work with may not share the same views, is what we want to caveat. I would also like to introduce the panel members to the webinar, and it is my privilege to speak a couple of lines on each one of them. Our first panelist is Mr. GS Agarwal. GS, may I request you to please switch on your camera? GS is a CFO of Shriram Housing Finance Limited. He has close to 3 decades of experience across multiple areas, including fund mobilization, treasury management, budgeting, planning, strategy, etc. He is a dynamic professional and enjoys excellent relationship with banks, financial institutions, and participants of debt capital market. Prior to Shriram Housing, GS was working with Magma Group as Group Treasury Head with additional charge as CFO for Magma Housing Finance. A very warm welcome to you, GS.
Thank you.
Our second panelist is Aparna Mantha. Aparna is currently head financial sector credit at HDFC Bank. She has close to 2 decades of experience spread across both retail and wholesale credit. In her current role, she also leads the securitization function. Aparna is a career banker with HDFC Bank and has done her post-graduation from Jamnagar Bazaar Institute of Management Studies. A very warm welcome to you, ma'am. Our third panelist is Nihas Basheer. Nihas is a partner at Wadia, Ghandy and Company. He is part of the firm's bank and finance practice. He focuses on securitization, bilateral transaction, stress assets, DCM, both offshore and onshore, structured finance and project finance. He is a frequent contributor to articles and literature on the Indian securitization space. He is with Wadia Ghandy since 2007 when he completed his BA LLB honors. In 2007 itself, he was also admitted to the bar. Nihas is also ranked in Chambers and Partners as leading lawyer in India in BFSA space. Very warm welcome to you, Nihas.
Thank you.
Our fourth and last panelist is Ramadasu Balaradu. Ramadasu is a vice president at Yubi Pool Platform, an independent market infrastructure platform for securitization transaction. He heads investor relations and products for Yubi Platform. He has spent majority of his career managing securitization transaction as credit analyst and also as an investment banker. He has spent more than a decade at our own institution, which is Care Ratings, as credit analyst before moving to Credit Revenue 3 years back. A very warm welcome to you, Ramadasu. A very warm welcome to all the participants as well for taking their time out to attend this webinar. In case participants wants to ask any question on the presentation made or otherwise, they are requested to key in their questions in the panel on your screen. We would take as many questions as time and panelists permit. Now we shall proceed with panel discussion and simultaneously also take questions from the participants. I take liberty to start with Nihas. Nihas, we are now largely 1 year into the new securitization guideline, right, which came last year sometime in September. And I think it would be a good idea to take stock of how the things have set up. So our question to you is basically, what do you think has worked well, and what do you think were the key teething issues, and how do you think that the market has adapted or adjusted to those changes? And do you think there is any major issue still persisting, right, which probably market would be better off taking up with the regulators for their guidance?
Thank you, Vineet. So I think from a securitization guideline perspective, obviously the 2021 regulations clarified a lot of positions and kind of just consolidate like the positions where, people are doing transactions on the basis of law firm opinions without really any regulatory clarity. And those kind of things got clarified in 2021 regulations. I think from a regulatory standpoint, we had always kind of said that the 2021 regulations has kind of improved upon what was already existing. I think the key winners from there were the ability to kind of resell assets which otherwise were locked in. Then you had your single loan exposures which could suddenly be sold again. So these kind of things have really helped both from liquidity perspective and just balance sheet management, etc. All of that. And that has really taken off as a consequence of these regulations. Now, of course, there were hiccups in the regulations, and I think most of them were pertaining to interpretation around a couple of the points that were there in the regulations. One or two to take up is like the MHP point on, how do you kind of calculate what is registration? Because you essentially, for secured loans, they've said it's 6 months from registration. The question came, does it mean like a mortgage registration? And then therefore for commercial vehicles, what are you going to do? Is it going to be, is RTO registration considered necessary, etc. All of that. And some people even have analyzed whether registration with CERSI would kind of be sufficient to kind of start counting. Those are issues we were grappling with on this, and I think the market has gone ahead and understood that, RBI has really not defined what they intended by registration, and therefore, so long as you're taking a consistent approach vis-a-vis your securitization on what would you count as registration, I think that is how the market has kind of evolved on that. The other issue which I think are facing is, the previous regulations always said that while your cap on exposure should be 20%, to the extent you exceed the cap, there's just a capital treatment. Now, obviously, that line is not there in the new regulations, and therefore the question is there an absolute prohibition, or it's still a capital charge question? And while we think it's still a capital charge question, the regulations are still not clear, and people are kind of obviously how to kind of address that issue. The other problem we could think of was only from the housing, residential buildings were like, because project loans cannot be securitized. Then the question came that, you cannot pass project risk on. So what is date of commencement of commercial operation for a residential building? So that is something that people are grappling with, because technically date of commercial operations has always been used in an infra project from when you could monetize it.
Very true. Very true.
Residential building, if you look at it, I can monetize it the day I get my first approval. RERA registration is all that I need to monetize it. Therefore, the question is always, how do I kind of do I use the same parameters used for infra projects, which is you get a construction risk is completely over, or do you end up using a different parameter for residential buildings because monetization is much earlier? So that, honestly, I don't think there's a uniform approach in the market even now. And that's a question I think that's still open. I don't think anyone has reached a consensus on that one.
We have already started getting questions. Mridul, are you there on the call?
Yes, I'm there, sir.
Mridul, there is a feedback that the video is going in a loop. So can you please attend to that and see if it can be corrected?
Sure.
What I will do, I'll also take the questions as it comes. So there is a question whether the data presented represents the whole industry or is it care-specific data. So the pool performance and the rating data that we have presented is actually for the care-rated transactions only. This doesn't represent the whole industry. Another question that we have is which are the asset classes which have prominently experienced downgrades? So much against our expectation, the most downgrades that we have seen are actually pertaining to housing loan pools, and these are, as we highlighted in the presentation, were more technical, fraught with the legal challenges than to do with the performance of the underlying pool. Yeah. Nihas, there is another question for you, which is basically in the context of bankruptcy remoteness, right? The transaction now, the sold assigned portfolio, securitized portfolio remains on the balance sheet of the originator. How does that play in terms of bankruptcy remoteness? What's your take on that? And how should one take comfort on that?
So that I think has been cleared by how DHFL itself played out, where I think it has been clearly set out that, once you've securitized it under the RBI guidelines, those are bankruptcy remote receivables. And in fact, they brought out a specific circular to clarify that those cash, even if it's received in DHFL's account, it should be passed on to the acquirers of those loans. So there, I think that question right now under law is kind of settled. As long as you meet the RBI parameters for securitization, that is bankruptcy remote. The accounting treatment should not impact the legal treatment in a bankruptcy.
Okay, so that position is well settled, is what we understood from it. Okay. Now moving on to Aparna, ma'am, you actually have been wearing dual hat in the sense that you are handling the direct credit exposure to NBFC sector as well as looking at the securitization transaction. So in the context of this bankruptcy remoteness and the asset continuing on the balance sheet, how do you look at it as an investor in securitized PTCs? And also, how do you look at from the other side when you evaluate the balance sheet of the borrower, which has got securitized asset sitting on its balance sheet?
So, hi, you can hear me, right?
Yeah, we can hear you, ma'am. It's loud and clear.
When you're looking at, underwriting, or when you're looking at a financial institution, you look at securitization or direct assignment as one of the ways in which they borrow. While as an investor, I would do a certain level of cherry picking and, selection on the loans that we buy. But, from a lender standpoint, it is just one of the vehicles. If they have a more diversified borrowing mix, which includes securitization and assignments, and that's in fact a positive in terms of how they see it. Also, the pool performances, because those indicate a certain level of portfolio performance. They could be, they reflect how the inherent portfolio quality is. So it actually gives us an insight into how the the performance of the originator.
Okay. So again, I think there are more legal questions coming then on anything else. So probably this one is to Nihas. Now that FLDG structures are prevalent in digital lending transactions and these are being compared with synthetic securitization, what is the future of FLDG structures? So short answer, Nihas, probably would be that these cannot be classified as synthetic securitization. Is that right, Nihas?
Yeah. So securitization by itself requires some sort of a transfer in the first place before you can call it. So synthetic securitization obviously has elements where credit risk is being shared, etc. All of that doesn't mean that a guarantee becomes synthetic securitization without the key elements of an SPE in between and an actual transfer. We still don't know what the intent of RBI was by putting that, to be honest, because if you just read that line simpliciter, any third party guarantee today is a synthetic securitization. If I were to take that analogy further, because there's nothing but a guarantee being given. So, if you ask me, that is not synthetic securitization at all.
Right.
And that's a short answer.
I hope that clarifies. So my next question is diverted to GS. GS, you have been associated with securitization market and debt capital market for a very, very long time. And if you recollect, some time back, mutual funds were regular investors in PTCs. And of late, their participation has been rather missing, right? So maybe this has something to do with aggressive pricing from the bank on PTC side, or because of shrinking AUM of, let's say, credit funds, right? Now that could be a possibility. Now, in the current scenario, when credit spreads are probably at all-time low, do you see that there would be appetite coming back from mutual fund industry, or do you think that more needs to be done by industry to get them back to market? What's your take on that?
Yeah, so Vineet, there are two reasons why, in my view, why mutual funds are away from the securitization market. One is after this, like mutual funds were very active in the securitization market till during 2017, 2018, FY 2017 and 2018. But post that, once this liquidity crisis happened with the NBFCs and NBFCs were grappling with resource raising in 2019 and 20, then COVID came. So this was a time when mutual funds backed out from securitization market completely. And So that is one. I mean, their loss appetite was very limited, and as we know that mutual funds are very, very conservative investors, so their loss appetite is as such very low. So they shied away from the market. And second reason, as you told, is also right, that today the competitive pricing with the banks, where the mutual funds can't match with the rates with the banks offer, either whether it is a PSU banks or whether it is a private banks. So these are the two reasons why mutual funds are now completely away from the market. But I believe that sooner or later, when the price gets stabilized, and also the confidence now, because now its pandemic is past now and the industry is growing, the securitization pool performance has also improved significantly. I believe in a coming 1 year, mutual funds will start coming back to this market.
Okay. Ramadasu, how do you read this? Do you have a similar view or you have a different view on this?
You are on mute, Ramadasu.
Yeah, sorry. So I have the same view, so, but the reason being that one of the biggest is still banks are able to give very competitive rates, even though that bond markets have been up by 200 bips, so the banks, that either MCLRs are not, not moved much. So, banks are still competitive. That is what I can say from my side. And over a period of time that would reduce, and NBFCs are also would come up that rates. The reason being there is a significant disbursements which is happening, that actually market is uptick. In fact, I can tell you, just sitting here, we have got from since last 15 1 month, there are requests which has come from mutual funds, there is exploratory talks which they want to look at that asset and all those things. So also the challenge is mostly they continues to be with secured asset classes. So if they are ready to look into unsecured, there is so much asset is available at right price at so where the prices are ready to leave on the table, by these NBFCs. So this is some of the other points which I wanted to add, Vineet.
Okay. So, Ramadasu, my next question is to you again. Basically, you interact with lots of investors and issuers, right?
Yeah.
And as you are aware, and as we have also put out in the PPT, the credit rating for PTCs have been very resilient with minimum instances of downgrade, right? Downgrades. Yeah. And we are seeing that there is increased interest among newer or smaller NBFCs, right, to tap this market, right?
Yeah.
So, my question to you is, do you think that credit rating stability of PTCs is helping smaller entities in fundraising? Or do you see any special preference of investors in terms of looking at a specific asset class? How do you see this market?
Yes, rating stability required for small NBFCs. That gives confidence to investor community. So a lot of times, if there is any volatility in the ratings, so they might get rattled, what is happening around. And in today's scenario, just due to broadened investor base, there is a market available for every asset class. If the asset is really good, it is available at right price. Just typically there is a huge demand for mortgage and gold assets on account of the past, which your presentation is also showing, some of the assets are particularly gold and mortgage, even though because of technical reason that its assets have been downgraded. So that asset, there is a huge demand from particular section of or in fact from every other investor, base. This is it from my side.
Okay. So there's a question. One second. I'll just read out the question. The question is, the due diligence is now required to be done for 1/3 of the pool by the assignee. Does this apply to KYC compliance of underlying pools too? I don't know. Nihas, would you like to take it? Nihas, Aparna, or maybe Ramadasu?
Yeah, so see, I'll tell you the practicality. Like Nihas and Aparna can add this thing. Yeah. So yes, so that is applicable for KYC also. That actually what banks are doing is 100% KYC. It is not applicable for only for 33%. So 33% they are doing for asset diligence, whether that asset has been qualified for their given their internal credit norms and all. But banks are doing that 100% diligence. So as far as where we are actually participating, from the platform side.
Yeah, even I have the similar view. Like for KYC, banks need to do 100% due diligence, and for the asset class diligence, they can do 33%.
Okay. Nihas, any views?
No, I think that's the same approach that is taking.
Aparna?
So I look at it a little differently. See, while the requirement is 1/3, you are buying the advances and you are taking on the risk on the portfolio. So while, you can, the minimum requirement, I mean, it could be 1/3 and you're doing 100% KYC across the board, but you have to satisfy yourself on what you are buying in terms of the due diligence that is being done. So whether it's 1/3, whether it is 50% or, even 100%, it's your internal comfort level. It is your internal policy and your threshold. So I think the 1/3 and 100% stays, but every originator, every transaction is different, and you need to kind of due diligence accordingly.
Very true, very true. So each bank would have its own policy and processes which probably they will follow, and they will take the onus of satisfying the regulatory is how it is. Staying with you, Aparna, what we have consistently observed that in general performance of the securitized pool, rated pool, has been better than the own book portfolio of the originator, right? So what do you think could be the possible reasons for this, and does this as a lender, right, give you more comfort in terms of building additional risk appetite, covering both, let's say, credit risk and performance risk, or dissecting the two between credit risk and performance risk? How do you look at it?
So I'll handle it in parts. The first question being, that we see securitized pools showing better performance than the overall portfolio. The most obvious reason is that, these are cherry-picked contracts. These are, they meet a predefined selection criteria. There is a certain level of due diligence that is done on these contracts, and then they are, selected. So they are, in terms of the rest of the portfolio, it may or may not meet the requirements or meet exact standards of the securitized pools. Also in terms of seasoning, because, there is a certain minimum threshold, minimum level of seasoning that these contracts go through before they are purchased. So there is evidence of repayment track record. And repayment track record is by far the most important criteria when you're buying, when you're buying transactions, because it's proof of the pudding. How we look at it when you are assessing credit risk, or when you are, you expect securitized transactions to do well, because there is a certain level of conscious selection that goes into picking contracts and selecting them. So let me flip it a little bit. If the pools do not do well, it is definitely a red flag. But if they continue to do well, it is business as usual. So that's how we look at it when we're looking at transactions.
Okay.
Because it gives that confidence to, both the investors and the originators that yes, the criteria is correct, and the pools are performing fine.
Okay. Ramadasu, you have any view on this?
See, just my view is what I echo with Aparna, the first part, the performance has been significantly good, or very different from their own book, is because of the performance, because of the cherry pick which banks or investors are doing, so on the day of, on the day before they're investing. If you run the scrub and all those things, we know really what exactly currently the borrower is being so easily defaulting with other borrowers, other lenders or not. So, so that is the reason, what we see is even our, data is also showing, wherever there is the scrub which has been scrub or any other performance which is doing by them, so it avoids the the fraud, initial fraud and all those things. So one more point which I wanted to add is so where non-performing assets because of low seasoning is also going to get away, is also one more because of the seasoning. So in a majority of the NBFCs, what happens is generally maybe in 3-4 months, if there is any fraud element, which also goes away after that account has been seen by 6 to 9 months just performance. Yeah, Vineet.
Okay. So thanks for that, Ramadasu. There are a lot of questions on the future of securitization market or DA market, and how would co-lending probably interplay with let's say direct assignment, etc. So probably I'll request probably GS to take this. We have seen that in last maybe 6-7 years the PSLC market has come from nowhere and has probably gone to a volume which is 6 lakh crore today, right? But for this, probably the way NBFCs would have probably behaved, right, in terms of what the market would have behaved, would have been certainly very, very different, right? So 6 lakh crore of demand going away is huge, right? So that already has the impact. In spite of that, we have seen that the market has initially grown till maybe FY20, right? Then because of COVID, etc., it came down. Now there is again a huge regulatory thrust from the regulator, from the Reserve Bank of India, to encourage co-lending model, right? Maybe with a view to de-alienate the risk from the NBFC and bank, etc., whatever may be the logic, right? So what do you think is the interplay between co-lending as a business, as a product, and DAPTC on the other hand as a product? And do you think that over a period of time, co-lending would eat into the market of DAPTC?
So I don't think that immediately co-lending is going to eat away the securitization market, because co-lending, we are far away from getting it completely accepted by the industry, though RBI is pushing a lot to the banks, even to us also, to enter into co-lending arrangement. But now we have seen that there are a lot of sign-ups have happened in co-lending, but hardly any transactions. Some straight transactions are for MFI or some, unsecured loans are happening. But for asset-backed class or for mortgage, there are hardly any deals are happening, disbursements are happening. Like for our example, we have also signed up with one of the premier PSU bank for co-lending, but nobody is ready in terms of the system integration, because that is a big challenge for system integration. Though Yubi and other intermediaries are helping to get a uniform platform where both the originator and the investor can work together in terms of reconciliation, in terms of data origination and all that. But still, that is a little away to get the complete acceptability. Securitization market has been well trusted, and it has been since 2006 guidelines, this market has developed a lot. And I think this is going to be there for quite some time, maybe in a couple of years' time, when there will be a liquidity issue or capital issue, then only because everybody wants to grow their own book instead of sourcing for someone else and just remaining with a small share. So in my view, in a couple of years, securitization market will going to be there, and then let's see how co-lending gets transformed and accepted by the industry.
So essentially, they are saying that sense of ownership, owning the client, probably still will survive, and probably it could act as a deterrent for development of co-lending.
Because in co-lending, few transactions which are happening in the CLM2 method, which is as good as a direct assignment. So I think CLM1, hardly Ramadasu can vouch that hardly there is any transaction which has happened so far in the industry.
So just Vineet, I take this thing. I wanted to add something, even though you are not asked me, banks are very upbeat, about this thing. They have signed. Unfortunately, there is no solution for scaling up. So maybe they may do something which can end of the day going to manage by so on the Excels and all those things. I don't think that is good for any other any asset class, just any asset to be created or built. Now, recently, so someone large PSU bank has signed with that is there in public domain, like, for this thing, co-lending. So irrespective, banks are going to sign and all those things. It is not possible for me to sign with every other, player in the, market, because the program is going to be limited to, with 3 or 4 players or 5 players. So for other assets, in which when they want to do, so with other orders, when they wanted to continues to do DA, continues to do DA or continues to depend upon the DA as a product. And also one more thing is they see that benefit while doing the DA, all these diligences, all these regulatory challenges, operational issues, reporting, and all those things going to go away. That is what they have been feeling, and that is the reason there is a lot of upbeat. But let's see how the market is. But personally, I don't see we don't see any the challenge in the volumes at least next 2-3 years until unless banks find this co-lending as a size.
You have any take on this, ma'am?
So I think co-lending, it's early stages. Securitization and DA market is at least, 15, 17, more than maybe 15 years old. So it's going to take time to catch up. But, I go back to what I said previously. It's just one more source of borrowing for, and fundraising for NBFCs and financial institutions. And the more diversified the source of borrowings is, it is a point of strength, and it's a point of, it's a positive for NBFCs and FIs. So absolutely, that's my take on it.
Securitization is now largely 3 decades. DA again has been surviving for more than 2 decades. That's very true.
Yeah.
That's bring me to another interesting point on securitization. That's largely in terms of alternate services, right? Internationally, we have seen that there are specialized professional third-party servicers who are there, and that has probably helped have the market there, right? While when we look at India, we have seen maybe second party, third party being the investor taking over the servicer, third party being third party. We have seen a few transactions where second party, third party has taken the servicer role, right? And comparatively, we still lack the professional third party services in India, right? What, according to you, Aparna, are the reasons why third-party servicer as a service provider, as a specialized service provider is not evolving in India? Are there legal operational reasons around it? And attached question to that is, with evolution of digital infrastructures in last maybe decade or so, right, including ENSCH, etc., do you think that there is possibility of structures evolving where service risk is greatly minimized, if not fully eliminated, especially in asset classes where dependency of cash collection is very, very low? So what's your take on that?
So in terms of third-party servicers and whether the market is ready, see, there have been one-off instances in the last few years where somebody else has stepped in and taken over the servicing. But the biggest reason that is holding back originators from transferring servicing to others is probably the data confidentiality. You want to own the customer. The customers on the ground do not know that these loans have been sold. You want to ensure that processes are strong enough that, customers are, that information, dissemination to the customers on the ground, that these loans are securitized loan and hence somebody else is coming and collecting on their behalf. Data privacy, because you don't want your database to be used by other originators or other, institutions which also could take over the servicing role. From a competition and those kind of reasons hold back, the setting up of third-party services. But I guess people who are not in competing businesses could set up a third-party servicer roles, because we have vendors doing all kinds of activities where data is handled. You have right from sourcing to collection to, even holding documents, which is outsourced. So it's probably a matter of time, but, this is one of the reasons. If that's taken care of, I think third-party servicing is I mean, there is potential for that. Moving to your question about, where a lot of collections happen through digital modes, it is easier to, kind of move servicing to somebody else, given that a large portion of collections is, coming digitally these days. But see, servicing is not about part collections moving. If you move a transaction, you have to move it entirely. And that will include digital and non-digital modes of collection. So if these operational issues are taken care of, I think third-party servicing is a very good option for a lot of transactions, when it gives a lot of comfort when you're actually buying as an investor also. On the legal part, I think I'll let Nihas take care of that.
Yeah, Nihas, if you could briefly touch upon the legal issues that could emerge if third-party services to come into picture.
So honestly, the legal issues are really not there, because if you look at it, what the servicing is a role which the lender otherwise would have had to do. And as far as the lender is concerned, the customer is already given all kind of consents required in favor of the lender. And all that at one stage we have an assignment, which means there's a change of a lender. And the new lender is just appointing a new servicer, which is nothing but its own agent. And for that, really, there's no additional legal kind of either from data security perspective or, data retrieval perspective, there are no issues there. The only issues that could come is from a security creation perspective, where normally what happens, like especially in a mortgage situation, the mortgage is created in favor of the originator and he continues to be the servicer. Now you get a new servicer, is the mortgage, now to transfer a mortgage is quite a tedious process in India. And in fact, the instances we have seen where mortgage MBS transaction services have been changed, they've actually not gone ahead with the transfer of mortgage. They just used the fact that there is a transfer of receivables and there's a notice given to the customer that the receivables have been transferred. On the basis of these two documents, they've been going and enforcing the security. So far, touch wood, there's been no problems doing that. But technically under law, today these all retail customers, they probably are not able to raise the defenses on documentation, which a more sophisticated borrower can. And you could have a situation tomorrow where a sophisticated borrower gets up and says, when a backup servicer there, like, I haven't created a security in your favor, like, who are you? How are you enforcing security? So those kind of issues probably can arise, security enforcement perspective. So far, all of that has been managed. We have actual instances of that being managed, but it's not a clear-cut solution. It's still, that Indian system of Jugaad. We still don't have a perfect solution. Obviously, if the law was a little more clearer on this, it would have been helpful. Or we probably change our documentation even for a retail customer to kind of say there's a security trustee arrangement from day one. Let the originator himself be the security trustee and he holds it for everyone. So probably when the collections change, you can ask him to continue to be the trustee for that purposes, while all actions are run on the ground by the new services. Something of that sort is probably what you can look at.
There is a question on CLM transactions. Is the requirement for legal opinion there? Circular says direct assignment guidelines apply. So my understanding is direct assignment guideline doesn't require any legal opinion, but Nihas, you can confirm this?
Vineet, why would you say that? But anyhow, no, I agree with you. I don't think direct assignment, there still might be a problem. But CLM and DA, what we've been telling some of our clients is, instead of doing it on a transaction by transaction basis, what you can do just to satisfy that there's one innocuous paragraph in both guidelines, which kind of can give an interpretation as an opinion required or not. So I said, when you're putting your co-lending documents in place, just take one opinion saying that as long as we follow this meets the criteria of the derecognition, etc., under the DA guidelines. So one time we've been kind of recommending that take it one time so that you don't have to do transaction to transaction. And our experience with the industry has also been that no one's doing it transaction specific. They're doing it at a one-time level so far, at least on CLM. DA, sadly, I think because of the RBI orders that have happened, even though there was a possible interpretation, people have resorted to now taking an opinion transaction by transaction.
So another question that we have got is that in September guideline on transfer of loan, right, there are certain specific changes which are required, and then RBI is also trying to do away with the regulatory arbitrage between banks and NBFCs to the extent possible. In that context, also there are certain changes. In that context, for direct assignment transactions, how are banks dealing with the requirement related to individual loan booking and then NPA recognition process? That's the question that we have. Probably Aparna or Ramadasu can take it.
I think Ramadasu can add.
Vineet, just I missed this. Can you repeat? Sorry.
So basically, for DA transactions, how are banks coping up with day-end NPA recognition requirement and the requirement to book individual loans for DA transactions?
Thank you, Vineet. So historically, banks were not booking loans at borrower level, rather were following a transaction level booking and monitoring. Now, a few banks which tried to loan booking went through challenges of data paucity or inability to follow their SOP on customer level diligence, KYC verifications, time lag in obtaining repayment data, CBS. All just they were unable to manage these complexities of DA transactions. Especially this thing is reconciliation. Also, day and NPA was not possible because of most issuers are reporting only once in a month. However, thanks to technology today, some of the platforms enabled direct API integration with issuers, LMS, collection system, and with the bank's core banking system. Reporting due to through which NPA, DPD collections and other data points are made available on daily basis. So our experience, in this case, is some of the banks are just trying to do what I use the word jugad, instead of integrating through API. Some are providing daily MIS to the banks. Just they're sending daily MIS so every loan by loan. So unfortunately, banks doesn't have any systems how to use this or how to consume this thing, but it is keep on on their systems. It is they're piling up this data on their systems. Once if they consolidate if they try to consolidate, they're not able to do for consolidation of this data. So that is the reason just they're using some technology platforms which are there available in the market, where these platforms are able to open directly in their CBS core banking systems, directly open those accounts individual account by account, and able to put the accounting and able to put their whatever there's debit, credit, whatever the interest and everything, just they're able to do from through the technology this thing. So so this is from my side, Vineet.
Yes, any take on this?
Yeah, so I agree with Ramadasu, because now their integration is the biggest challenge here. We can provide the data to the banks on a daily basis, NPA, but how do they use that data? How do they integrate with their system and upload that data in the system is a big challenge right now. So I think PSU Bank have still not started. They have not even started asking for a daily NPA data. Yes, but the opening of individual customer-wise account, they have already doing it. So most of the PSU banks or private banks where we have done DA transactions, they are all getting the customer level data and they are opening the customer level accounts. But daily NPA tagging is still a little, I think, challenge as of now. Okay. But it is compulsory from 1st of October. So maybe next month onwards, we will see some traction on this and banks will start demanding for the data. And then we need to cross the bridge as it comes.
Staying with you, DS, what can be done to induce risk appetite of long-term investors for PTC market? What's your take on that? Do you think it is still very, very remote, or do you think that that's probably a difficult task?
No, so long-term investors are still not coming to PTC market like insurance funds and mutual, provident funds. They have, and it is mainly because of the non-tradability of PTC instrument. PTC as an instrument initially RBI had taken certain steps to list the PTCs and making it a tradable instrument. But I think there are hardly any trade which happen in the PTC market. So unless and until it starts trading freely, I don't think the long-term investors coming into this market so soon, because they need an exit point, and unless and until they get that exit, they will not be coming to this market.
Ramadasu, any take on this?
Yeah, just I have one point, Vineet, the reason, so last 1 year we would have reached out to some around 10 to 15 insurance companies and provident funds and in insurance. So in fact, there was a report, there was a instruction for government, or there was advice from government, start investing in structured instruments or PTCs, particularly to provident funds where the yields are little higher as compared to the normal traditional this thing, but still it is not happening. So what we actually find out is one important thing what JS is saying is liquidity, but second most important thing is where there is a lack of product knowledge with them, the most important. And also, even though just some of the people are there, when we were interacting with one of the in a pension fund, so there was a lot of intent. The problem was so who will monitor, who will monitor month on month, if I have a take an exposure on the entity. So there is I don't know, tons of reports which are available about that entity, how it is happening. Rating agencies are covering multiple rating agencies are covering what is the performance of what is the performance of this entity. Everyone would give something or other about it. But particularly PTC, it will be limited to one entity which the rating agency has been doing on the asset, and also they need to set up a desk to look at these transactions, how the performance has been happening month on month. There is some track. They need to track what is the collection efficiency and all those things. So this is what we have seen, so where this is what the common answers we keep on getting from these people, why they are not in investing, and so that continuous guidance or continuous sessions are going on from our side, but so there is no much success so on this particular.
Yeah. So there is another question probably which Nihas can address. Is co-lending model also applicable for HFCs? My sense is I don't think there is a restriction, but what's the take of panelists here? Co-lending by housing finance companies?
So housing finance companies also now classified under NBFC. So technically there's no distinction there between an NBFC and an HFC anymore from a regulatory perspective.
Okay. So I think we have pretty much run out of time. We started with regulations. I'll finish with another last question probably on regulation. This is probably, we'll first take inputs from Nihas and then other panelists can add. The guideline in September 21 also introduced the concept of STC transactions, simple, transparent, comparable securitization transactions. And there was preferential capital treatment also for transactions which get classified as STCs. While we have seen few transactions which claimed to be STC transactions, but those numbers is very, very small, and I'm not sure whether those transactions were finally classified as STCs or not. What do you think, Nihas, can be done, or what do you think is constraining the pickup of STC transactions, and what can be done to give a boost to it?
So honestly, I don't think there's any huge challenge in getting an STC transaction done. The problem is there any incentive to do it? And that is where I think the issue comes, because honestly, STC, one of the biggest beneficiaries will be the originators themselves on the retained exposures. But even to get that benefit on the retained exposure, you need the retained exposures to be rated. No one rates those exposures. And even if you rate it, I don't know whether you will get a decent enough rating to make a difference in the capital treatment. I think it's just a question of getting to a stage where the originator himself understands the benefit of the STC rating that he gets. Because right now the originator is looking at it like it's only the investor who's getting a benefit. So what's my incentive?
Essentially, you are saying that the benefits are loaded in favor of investors and there is no sizable incentive given to the originators to push for STC transactions.
There is benefit given to originator, but because our transactions don't rate the retained exposures, it's not a norm. So if you're not rated, you don't get the benefit of STC. So originator is seeing no benefit because he doesn't rate his retained exposures.
So what's Aparna and GS perspective on this? Maybe.
Yeah, as an investor also, I mean, you are buying those loans. See, it's about why are you investing on those transactions? Most of the investors today are investing in it for PSL purposes or for asset building, not really capital relief, as the major benefit. So, again, like adding to what Nihas is saying, there is no material benefit that I'm going to derive from pushing the originator to get it, have an STC rating on it. And it doesn't matter.
Yeah, I convey the similar view with Aparna and Nihas, because there is no apparent direct benefit to get my exposure rated as an originator. So nobody is looking or pushing into in that direction.
So, Vineet, I have one just on this little contrary, I can say. So I think there is some confusion. So there are around 40 points why you need to qualify this as a PSL. Why you need to qualify this as this thing. There are 40 points are there. So every point, every investor is reading differently. So that is also one more this thing. What I gathered is some of the foreign banks have written to RBI. I don't know what is the response from RBI. So this is also actually which I have a practical challenge which I have seen, which I see in the market. Yeah, thank you.
Thanks. So that's pretty much from my side. I'll hand over to Mridul. Thanks, GS, Aparna, Ramadasu, and Nihas has to log out. So over to you, Mridul.
Thank you, Vineet. Thank you for hosting this and moderating this session. And thank you, Shriram, for your presentation. I once again thank our guest speakers, Mr. Agarwal, Mr. Aparna, Nihas, and Mr. Ramadasu for the insightful views. It was a privilege to host you. And thank you again to all our participants for being a part of this CareEdge webinar. For any feedback, queries, suggestion, you're most welcome to write us in the comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now. I request the tech team to log off, please.